ETFs are some of the most powerful tools for long-term investors, but with thousands to choose from, picking the right ones isn't always easy. And in this video, I'm going to share with you the 6 best ETFs that can make you rich over the long term. Now, whether you're just getting started or you've already been investing, these ETFs are all about strong returns, boosting diversification, and most important, simplicity. So let's get right to it. First up is a sector-focused fund, VGT, which is the Vanguard Information Technology ETF. This fund seeks to track the MSCI US Investable Market Information Technology 2050 Index, which is made up of US companies in the information technology sector. VGT contains a total of 313 stocks, with top holdings in companies like Apple, Nvidia, Microsoft, Broadcom, Salesforce, and others. As you can see, its top 3 stocks, Apple, Nvidia, and Microsoft, make up almost 50% of the fund, so they can have a big impact on price movements. Moving over to sectors, when it comes to technology, VGT is primarily exposed to industries like semiconductors, system software, tech hardware, and application software. VGT has a low dividend yield of 0.58%, which is expected since it's composed of many companies that are focused on reinvesting their earnings into development and growth rather than paying out dividends. Getting into the cost, this fund has an expense ratio of 0.09%, so you'd be paying $9 yearly for every $10,000 invested. VGT has had some pretty incredible performance, to say the least, with 5-year annual returns of over 21% and 10-year annual returns of just under 19%. And if we compare it to a broad market S&P 500 fund like VU, you can see how big of a difference in gains VGT had over the general market. While the returns can be amazing, it's important to keep in mind that technology can be very volatile, and this fund is heavily concentrated around 3 major tech companies. With that being said, VGT can be great for investors that are looking to get more exposure to the technology sector and its future growth potential, especially when it comes to AI. Next up is a small cap ETF, AVUV, the Avantis US Small Cap Value ETF. This fund invests in a broad set of small cap companies, and it's designed to increase expected returns by what it believes to be low valuations with higher profitability. AVUV is actively managed, so the portfolio managers are buying and selling assets depending on the fund's requirements and standards, as well as the economic landscape and other metrics. AVUV has around 789 stocks, with top holdings in Air Lease, Calmain Foods, Archrock, SkyWest, and Avnet, with exposure to sectors such as financials, industrials, consumer discretionary, energy, and a few others. For the dividends, this fund has a dividend yield of just about 2%, and since its inception, you can see that it's had some pretty nice dividend growth, along with 5 years of consecutive dividend growth, which is a nice plus. For the fees, AVUV has an expense ratio of 0.25%, so you'd be paying $25 a year for every $10,000 invested. For the performance, AVUV has had solid historical returns, with annual returns of well over 20% in the last 5 years, which is pretty amazing, and around 12.5% since its inception in 2016. Now, it has been a bit of a rough patch for AVUV recently, like many stocks, and the tariffs and uncertainty of the market are having a big impact. For someone looking for higher potential growth opportunities that do come with higher risk, a small cap fund like AVUV could serve well. Even in the case of just adding this fund to your portfolio for more diversity if you have ETFs that don't have exposure to small caps. But as rates hopefully come down in the near future, this will aid with the growth and momentum of these small cap stocks. The third fund we have is VU, the Vanguard S&P 500 ETF. VU invests in stocks in the S&P 500 index, which represents the 500 largest companies in the US. This fund gives you great exposure to a variety of sectors in the market, as well as a variety of US large cap companies that drive the economy. VU currently has a total of 507 holdings, with top holdings in names like Apple, Microsoft, Nvidia, Amazon, Meta, and others. And the sectors that make up VU are technology, financials, healthcare, consumer discretionary, and more. For dividends, VU has a dividend yield of 1.3%, which is paid quarterly. Nothing crazy here, but it's something thanks to the fact that it holds a variety of companies that pay dividends. As for the cost, VU has a very low expense ratio of just 0.03%, costing you $3 a year for every $10,000 invested. Moving into the performance, VU has had some really nice returns with over 18% annually in the past 5 years and over 12% annual returns in the last 10 years. It's hard to go wrong with VU as it's a great core foundational ETF to have in your portfolio that gives you diversification with both value and growth, as well as the solid historical performance that the S&P has had over many years. The next fund is QQQM, the Invesco NASDAQ 100 ETF. QQQM invests in large cap growth stocks in the NASDAQ 100 index, which is an index that includes the largest 100 non-financial companies that are listed on the NASDAQ. QQQM contains about 106 stocks with its top holdings in popular names like Apple, Microsoft, Nvidia, Amazon, and Meta. And its top sectors are in technology, communication, and consumer discretionary. Definitely a fund that leans quite heavily towards technology, as you can see. Getting into the dividends, QQQM has a dividend yield of 0.64%, which is paid quarterly. And of course, this is no surprise given that this fund is geared towards growth stocks. When it comes to the cost, QQQM has an expense ratio of 0.15%, costing you $15 for every $10,000 invested. When it comes to performance, I'm going to be using QQQ data instead of QQQM since it's been around longer, but they're pretty much exactly the same. QQQ just has a higher expense ratio and more trading volume and liquidity, making it a better choice for traders. For performance, QQQ has had 5-year annual returns of around 20% and 10-year annual returns of just about 17%. This fund has proven to offer some great returns over the long run. For example, here's the returns of QQQ versus an S&P 500 fund like VU over the last 10 years, easily outperforming the market by quite a margin. Like any growth fund, it does come with more volatility and risk, but for those with a higher tolerance and appetite for risk, QQQM is a solid ETF that's had some great long-term performance. The fifth fund is DGROW, the iShares Core Dividend Growth ETF. This fund seeks to track the Morningstar U.S. Dividend Growth Index, which invests in stocks that have a history of consistently growing their dividends. Along with its great index filters that include solid companies, it combines a mix of growth and value to offer a well-balanced and diversified portfolio. Currently, DGROW contains 417 stocks, with top holdings in companies like Microsoft, JP Morgan Chase, ExxonMobil, Apple, and Johnson & Johnson. Getting into the sector breakdown, you can see that financials is the largest sector, followed by technology, healthcare, and consumer staples. Now, when it comes to dividends, DGROW has a dividend yield of 2.3%, which is paid out quarterly. And it's had some great dividend growth, to say the least, with 10 years of consecutive dividend growth, so it's really been on a roll. DGROW has an expense ratio of 0.08%, meaning you'd pay $8 in fees for every $10,000 you have invested. And while DGROW is a dividend ETF that's pretty diversified, it's managed to offer some good returns with annual returns of around 16% in the past 5 years and 11.5% over the last 10 years. DGROW gives you broad exposure through a value-oriented portfolio of consistent and reliable dividend-paying large-cap companies. Its high-quality structure, great track record, opportunity for growth potential, and steady dividend increases makes it a solid pick for a dividend ETF. This next fund is SCHG, the Charles Schwab U.S. Large Cap Growth ETF. The goal of SCHG is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. SCHG currently holds 229 stocks, with its top holdings in names like Apple, Microsoft, Nvidia, Amazon, and Google. Which you can see here, this fund is especially concentrated in these Mag 7 stocks. The sectors that this fund is mostly exposed to is technology, communications, and consumer discretionary. For dividends, SCHG only has a dividend yield of 0.45%, which for a growth fund is not much to see here. When it comes to the fees, SCHG has a low expense ratio of just 0.04%, costing you $4 a year for every $10,000 invested. Getting to the best part when it comes to growth funds is the performance, and SCHG has had annual returns of around 20% in the last 5 years and annual returns of nearly 15% over the last 10 years, which is really great to see. SCHD offers strong returns at a very low cost while investing in some of the most influential growth stocks in the market. This, of course, comes with more risk due to the heavy exposure to technology, but that's always the case for these more growth-oriented funds. And unlike what you saw with QQQM and VGT, SCHD gives you exposure to more stocks, and it isn't limited to exposure in different sectors. Now, while the ETFs on this list are some great choices, putting together a portfolio of ETFs that align with your risk and investing goals is vital. And in this video here, I go into a variety of 3 ETF portfolios to help you build a portfolio that fits your needs. If you enjoyed the video, be sure to hit the like button and subscribe for more content. Thank you as always for watching, and I'll catch you in the next one.